Hey everybody, we're back to talk a little bit about the market, and as usual I like to put things in the context of sports, so we'll do some of that too, and just thought it was a good time for an update. Our Packers are off to a great start, 5-1-1 on the season. After week 2, the world had anointed us the Super Bowl champs. It was, for any longtime Packer fan, you knew this was too much. The talk that was coming out, it almost made it inevitable that we would have a bit of a hiccup, and sure enough we went to Cleveland and it was at least that. And so the market can be in the same place. The market's been doing really well and it's shown lots of positive momentum, but it's if you've followed the market long enough and you pay close attention, you realize that sometimes things can get so good that it should bring you some level of caution, let's call it. So we'll talk about this in a little bit more detail. The idea of momentum in the stock market or for a particular stock is actually measurable. You can plot it. There's a mathematical analysis you can do to say, show me how well the momentum factor in the stock market has done. It's really, put very simply, a measure of popularity. Something that's doing well does well because it's doing well. And it brings me to a comment that Benjamin Graham, the father of value investing, said way back when, and that is, in the short term, the stock market is a voting machine. But in the long term, the stock market is a weighing machine, which is just another way to say, in the short term, popularity can win and momentum can lead, but over longer periods of time, there's going to have to be some weight to the business in order for it to endure. So let's think a little bit more about this momentum thing and how we might want to at least be cautious. If you ever watch ski racing, I'm no skier. I'm actually terrified of heights, and so I don't even like going up to the top of the hill. But I've watched it enough times, particularly ski racing, where they'll show the skier coming down the hill, and they have these gates along the way. And what makes it cool as a fan watching is they'll kind of give you a status update on how well that skier is doing relative to those that have gone before them or any records that are out there at break points throughout their trip down the hill. And it's really exciting. So the announcer will be like, oh, here he comes into gate 2, and he's, 0.3 seconds ahead of pace. And, the people that are watching that, if they're fans of that person, they're thinking, oh my gosh, this is great. They're ahead of schedule. They're in first place, or they're tracking for first place. This is great. And they get to the next gate and they're still ahead, and it's a big number. And the fans say, oh my God, this is great. We're going to win. You get to another gate and they're ahead by a lot. And they say, oh my God, this is fantastic. We could get a world record. This is all true. It feels fantastic. You're seeing someone, and just like it can in your portfolio, when this is working, you can see that your portfolio's balance is going up and it feels amazing. Here's where it gets a little slippery. At some point here, you could be going fast enough that you get to a break and they announce it, and you're so far ahead and you're going so fast, or the racer is going so fast, that the people who know and care about that person are going to start to drift a little bit from, oh my God, they're going to win the world record, to, oh my God, they're going to crash into the parking lot. At some point, this is an unsustainable, dangerous speed, and you have to take that very seriously. And so what should that person do at that moment? What is the right thing for someone who's going so fast to do to protect themselves while still being successful? It is certainly not to make some massive, sudden adjustment or major change to what they're doing, or hit the brakes or bail out. All those things could be catastrophic, particularly at those speeds. It's just not, you're still in the race and you're still trying to win. What they can do is make very calculated, smaller, or less wild changes to what they're doing, to just dial it back a little bit to the place where they can still be successful, but not take that same level of risk, and kind of still benefit from all that speed they had gained earlier and finish the race in first place. The same is true today. So if the portfolio has gained momentum to the place where you're seeing your balances at places you never thought possible, or the market is going to places that you never thought possible, it is something to celebrate that your assets are growing. But it can get to a place where you do have to start thinking about crashing into the parking lot. It's also not the time to make a massive change. You don't need to sell your whole portfolio to cash or take everything you have and put it somewhere else. It's the time for calculated, subtle adjustments that keep you back in line but allow you to benefit from everything that you saw. So back to this concept of voting machine versus weighing machine. So when the voting machine is running in the short term and momentum's working, it's as simple as what's working works. If we want to look at something a little more fundamental, like a weighing machine, then we can look at a business and ask, long term, what attribute could there be of a business or of an investment that could give us confidence that this can endure? Something you can look at is the free cash flow generated from a business versus the total value of the company. Okay, and they'll call it free cash flow to enterprise value. And what it's basically saying is if I bought the whole thing and it produced a lot of cash flow relative to its total value, that means this business is a powerful cash generator. Okay? And so it doesn't really matter what environment you're in. On a relative basis, over a long period of time, a powerful cash generating business, meaning free cash flow, after all expenses and everything else, the free cash flow that it generates, certainly relative to the size of the business, is a powerful indicator of a fundamental long-term weight. So if we look at where we are today, in my view, it is certainly prudent to be thinking about taking or examining your investments, looking at where the voting machine has been paying you off and the momentum that you've gathered, and think about those subtle, calculated changes you might be able to make to transition some of that investment from the voting machine to the weighing machine. Value, which is another way today of saying, think about the growth investments that you've owned and the opportunities that may exist in value land, where we are hyper focused on this fundamental weight. So thank you so much for listening. I know the video is long. I hope you could bear with me. I'm going to be at the Schwab conference this week. So if anybody's there and you can come by and say hello, it'd be great to see you. Otherwise, thank you so much for listening. Appreciate it.